Welcome to the InterMarket analysis video update. This is a video that I do once a week where we look outside of the S&P to see if we can get any clues as to what's happening inside of the S&P itself. And I look at a number of different areas, number of different markets, just to see what kind of analysis can we get from other markets. And this is being prepared for Monday, November 3rd. Before I get into that, I have a thing called the SPX investing program, and here's a link right here on this slide. This same link is also below in the description if you're watching this on YouTube or Rumble. And if you're already a subscriber, please know that it is free until the end of 2025. So that I'm recording this at the beginning of November, so that's a couple of months. And check it out and just see what you think. There are a number of benefits that you have from that. You get immediate access to the videos once they're recorded. And that's the way these videos are designed, is to have immediate access. They're designed for right now. I record them as soon as I can, and then you have as much information available to you as possible to try to make some good decisions. There are also additional things that I post there. You have a couple of different choices. One is if you go to the website, the full-blown website, it's free, but you're going to have to provide payment information, and that's a Substack thing. There's another website where you don't have to provide any payment information. It's completely wide open, but you don't have access to quite everything that I post. There's some trade ideas and things like that that I post on the regular website. I just don't want that floating around out in the public because I don't tell people what to do. I just say, okay, here is a base to work from. And now you take that and now develop that into your own program. I'm a big believer in critical thinking, and I'm not I'm not a guru. I don't just say, hey, do this, do that. I know that a lot of people do that. That's how I'm different. I'm trying to teach you a skill, not necessarily just tell you what to do. So feel free to check that out if that's of interest to you. All right, the first area that I go through in this particular video is valuation. Now we look at the S&P itself for that. We look historically and we also look forward to say, okay, are we overvalued? And in a very short answer, yes, we are. We have been now for years. We continue to be overvalued right now. We don't use that as a timing mechanism. We just use it to say, okay, we're overvalued right now because it doesn't seem to matter until it does. And I know that it's open-ended and there's really no answer to that. So I don't use valuation as any kind of a timing mechanism. Then we look at growth versus value. This is a big deal. When growth is outperforming value, that's when the market is really going up. And we're still looking good with growth versus value. But going back to about the beginning of August, we're seeing it drifting down a little bit. We're seeing more shorter term weakness. Now, the bigger picture is still looking great. But when the market is starting to shift over to more value, that means it's getting more defensive. And we're at a point right now where seasonally we're very positive with the market. Looking at the charts, it's like, okay, maybe the market's going to throw enough of a curveball to everybody so that they don't just expect the market's going to go up from now until the end of the year. They're going to put a lot of doubt in people's minds. And then once that doubt is firmly established, then the market's going to do what it's going to do. And we've been seeing this building for a little bit now for the past few months, but it hasn't really led to too much. And so we're just kind of watching that as it shifts week by week. Then we look at inflation, which doesn't seem to be a problem right now. There's one chart that we look at that, okay, if we just look at that one chart, we should be concerned, but it's a proprietary chart. I'll point that out when I get to it. Other charts that we look at, the market doesn't seem all that concerned about things. And then we look at some other markets outside of the stock market. We look at bonds. We look at all kinds of different things because sometimes those markets may have an impact on stocks. Then we look at the 11 S&P 500 sectors. I look at an individual chart of that sector, and then we do a ratio to see how is it performing compared to the S&P 500. We look at a bunch of different indexes. And we look at correlations between different markets to see, are we getting any insight there? And then some very long-term trends using monthly charts, mainly with the NYSE and the S&P 500. And then at the very end, and there's been no changes if you watch these videos on a regular basis, we're just shifting a little bit, and we're shifting a little bit more, but no changes to the positive list or the negative list this week. All right, first we look at valuation. And we have a red dashed line right here, which is a PE of 20. These are static numbers, and we're well above that. The black line is the S&P 500, and you can see there's down below, there's the spread between the two. And it's like, okay, we're overvalued. So, yeah, but we've been overvalued for many years now. This also shows that same thing, the red dashed line, and then what price was doing. And you can go back all the way to 1980 and see that we spend a lot of time above the red dashed line. So we are overvalued. And it doesn't really suggest that the market's going to go down. A lot of times it's actually more positive because it just means people are willing to buy stocks that are already expensive with the idea of them getting even more expensive. And then we look at the Shiller PE ratio. This looks uses a smoothed approach over a 10-year period of time. It was developed by Robert Shiller, also coming in very high, 40.88. Just to give a little bit of perspective, the median and the mean is between 16 and 17. It's been that way for a long time now. So yeah, we're very overvalued according to this. But again, we don't use this as a timing mechanism. The market also uses forward-looking PE ratios. This is a chart put out by Edward Yardeni, and it shows the mega cap 8. He breaks it down into 8 instead of the magnificent 7. And we're coming in at 30.9 right now. We're above 30 with the PE ratio, even though we had an up week this past week, but we gave back a lot of the gains. And even with giving up some of those gains, we still are very expensive looking forward with the PE ratio. The red line is the S&P 500 coming in above 20. We still use that 10, 15, 20 scale. It's coming in at 22.8. And then down here, more fairly priced, are these underperforming parts of the market, especially the mid caps. They just can't seem to do all that well. They're just chopping along sideways. And then the small caps, they have little times where they're looking pretty good. Now, I look at the S&P 600. I also look at the Russell 2000. That's another small cap index. I like the S&P 600 for these types of purposes because you have the S&P 400, 500, and 600, and they're all geared towards the PE ratio. But a lot of folks use the Russell 2000 index, and that's just coming off of recent all-time highs, where the S&P 600, it still has a ways to go to get back there. But on a valuation basis, we're at 15.3 with the small caps. That's in green, and the mid caps are in blue. That's at 16. So right around that fairly priced level. Now, we look at growth. First, we look at growth all by itself. Doing okay, hanging out around its 50-day moving average, also in an uptrend. Then we look at value all by itself, also above its 50-day moving average, also in an uptrend. Where we get some insight is when we start doing ratios between the two. And this top chart shows how growth has been outperforming value, even though it's pulled back in Friday's session. And a few times this past week, it was looking really good up until about Wednesday. Jerome Powell came out and rained on everybody's parade and said, well, we're not quite sure we're going to cut rates in December. It's not a foregone conclusion. And that's kind of spooked the markets right now. And it's making things a little bit more defensive. And then we look at the bottom here, which is a value to growth ratio. This is an inverted version of the top chart, just to see if we get any insight that we're not seeing in this chart by itself. And they're pretty much mirroring each other right now. Then I look at a number of different growth to value ratios here. This is a couple of ETFs. This is still showing how growth is outperforming value. That's still quite positive. This is still showing how value is underperforming growth. This is a couple of indexes pulling back recently here, but in the bigger picture, growth is outperforming value. Value is underperforming growth. Then this is actually held up fairly well based around some other measurements that we look at. These are a couple of ETFs, a growth ETF and a value ETF, and then a ratio between them. Really doing quite well here, well above the rainbow, even though it did pull back recently. It bounced up slightly in Friday's session. This is that same thing, value to growth, showing how value is underperforming. Then we look at the small caps. You can see the index just kind of humming along, humming along. The Russell 2000 is doing a little bit better, but we still have a ways to go to get back to the all-time high that was set late in 2024 here with the small cap 600, the S&P 600 index. But they show pockets of strength and then just kind of give it back or just tread sideways. But when you look at the growth to value ratio, my goodness, this is looking really solid right now. And we just generated a recent golden cross with this ratio. Now, mid caps also the worst performing index right now. And I go through that in the deep dive video. I rank 6 different indexes. And for the last number of weeks, the mid caps have come in last place below 50. Usually above 50 is leaning more positive, below 50 is more negative. Mid caps are below 50 here, but their growth to value ratio is looking pretty good, especially when we compare it to the S&P. We're still hanging out above the 50-day moving average. This is where we're seeing some concern. Going back to the beginning of August, we topped out here with the growth to value ratio for the S&P. We've been coming down and we've just been kind of going along sideways. It would be much more positive if we could get back above the 50-day moving average, go up, stay in the longer term uptrend, and that would help power the market more than what it's already been powered by. And this has been a little bit of a concern, but we've been watching this for a few months now. And as I said earlier, it really hasn't led to all that much to this point. And we keep an eye on inflation. This is the one that, like, oh my gosh, head for the hills. Inflation's really outperforming deflation. This is a monthly chart. It's now complete since we finished October, but this is not being confirmed by other charts that we're looking at right now. And then we have a monthly chart of the CRB index. You can see it's just kind of humming along with a slight uptrend here. So the CRB index is not really shooting to the moon, but we see this ratio really going up. And this is developed by Martin Pring. I use a lot of charts that he developed. I read some of his stuff. He's very respected and I like his stuff. It doesn't mean it's always right though. But I still look at this and still make it known to you that okay, this is showing something, but we're not really seeing it in other charts. And we look at the daily chart of the CRB index, just humming along, going sideways right now. And we look at the Baltic Dry Index, which is in an uptrend. And as a general rule, when this is going up, that tends to be more inflationary. What does it cost to ship products in the Baltics? And when this is going up, it tends to be more expensive. When this is coming down, it tends to be less expensive. And so we are in an uptrend with this index. Now, as far as the market, there's an ETF out there that measures inflation expectations. Not really any problem here. We really haven't been going all that far. And then we look at inflation expectations to tips, which had been coming down. Now, tips are, they adjust for inflation, they adjust for interest rates. And when folks are worried about inflation and interest rates, they get into tips. And we can see they're outperforming a little bit, but not really breaking outside of this range. When this is going down, that means tips are outperforming. If this is going up, that means inflation expectations are outperforming, but not really seeing any concerns here. And there's other charts that I'll show and I use in other videos that go through this also. Then some other markets. We just look at these. I don't really deal with aluminum other than looking at this chart once a week and using it in this particular video. But we are in an uptrend here. That could be somewhat inflationary. Then we look at corn, which has been bouncing up, but it is also or continues to be in a downtrend. Wheat bouncing back up, also still in a downtrend. And fertilizer, it's bouncing, it's ticked up a little bit here. It had been going up, but now it's been pulling back. All these things can bleed through into stocks and into inflation. And so that's why we look at these. Lumber, which is in a downtrend and actually seeing some recent weakness here. And then oil, we watch this mainly for geopolitical reasons. It's still in the 60 range, so it's not really inflationary right now. We look at a correlation between oil and the 10-year yield, a fairly strong correlated relationship. When we get above this range that I have here, that's neutral. And then when they're going up, that means the correlation is pretty strong, meaning that they're going up or down at the same time. If we have a negative correlation, that means they're going in opposite directions from each other. Right now, they're having a slight tendency to go in the same direction. And then we look at gold to oil. Now, gold's been pulling back. It came up a little bit after it's had a pretty significant pullback here. And so it's really been going up with this ratio when we compare it to oil, but lately it's been pulling back as gold has been under some pressure. And then gas is in a downtrend right now. That's not inflationary. Heating oil just kind of humming along here in just a light uptrend here. Natural gas, it did kind of spike up a little bit here. It's in a downtrend, but we'll keep an eye on this and see if that starts to cause some problems. And diesel had been kind of coming down and now it's kind of going up a little bit here. So we'll just keep an eye on these different markets. Then copper, I look at this because when copper's going up and it's in an uptrend right now, that tends to say, okay, the economy is looking pretty good going forward from here. Then we look at a copper to gold ratio, which had been really coming down and it's still going down, But as gold was going down, copper was going up. So we saw a bit of a bounce with this ratio. But in the bigger picture, copper's underperforming gold. And this is a longer term look at the copper to gold ratio, which keeps going down. I also have the 10-year and 2-year yield on here. Those, for the most part, are settling into lower ranges currently. Not really seeing anything different than what we have been seeing here. And then gold here, where it really came up and then it's been pulling back. It's not even back to its 50-day moving average. This is the ETF, not the futures contract. I just track this right here. And then silver also going up here, setting new highs and then pulling back recently, then bouncing back up over the last few trading sessions. We look at a gold to silver ratio. When this is going down, that means silver's outperforming. When this is going up, that means gold is outperforming. And then we plot it with the US dollar index, and the correlation between the two right now is neutral. They're kind of hovering around the midpoint currently. And then the dollar, we want to keep an eye on the dollar. Now it's still in a downtrend, and on the weekly side, it's in a downtrend. But if the dollar really starts going up, and if it gets back above 100 and keeps going from there, that could put some pressure on stocks. You see, earlier in the year, we were really going down with the dollar, and then it kept going down as stocks were going up because stocks tend to like a weaker dollar. And we look at the euro, which has been pulling back a bit compared to the US dollar index, which has been coming back up. And then the Japanese yen, which is in a downtrend right now compared to the US dollar. And I'll show that chart coming up, where we're actually falling under the 50-day moving average and seeing more of a substantial decline when we look at the euro to the dollar. And then the British pound to the dollar falling underneath its 200-day moving average. Now, if we see continued weakness in these charts, that could put some pressure on stocks because that means the dollar is outperforming other major currencies. And then we are in a downtrend when we look at the Japanese yen to the US dollar. That crossed a few weeks back, and this is continuing to show some weakness. Then some different index ratios. We have the weighted versus the equal weighted version of the S&P. The weighted version's been holding up better because that's the mega cap stocks, and they've been kind of shining lately and really holding things together. Where we've been seeing a little bit more of a downward move here with the equal weight, which is the red index here. So the broader part of the S&P is not performing as well as a few individual stocks. And then we look at a ratio between the equal weight and the S&P. When this is going down, that means the equal weight's underperforming. And that's pretty much what it's been doing here as the really big stocks have taken control of the market. NASDAQ 100 to the S&P 500 still looking really solid here. Stocks to commodities, stocks are still outperforming. Inverted version, commodities are underperforming stocks. That's not necessarily inflationary when we're focused on the CRB index. The S&P 100 is really doing well. Those are the biggest stocks that make up the S&P 500. The NASDAQ continues to outperform the S&P, even though both are doing well. The NASDAQ's been doing even better. And we're starting to see this go back down again here, where the NASDAQ 100 is underperforming the NASDAQ. Now, there's a couple ways you can look at this. When we're really strong, the NASDAQ 100 is outperforming the rest of the NASDAQ. But we've been strong lately too, and you could twist that over into a positive way, saying, well, it's just because the NASDAQ's a bigger index, there's more participation there. So that should be a positive thing. And you would be right. Now, there's also the concern, though, that what about those companies in the NASDAQ? Some of them, we don't know a lot about them. They don't have really sustained earnings. A lot of these are AI driven companies that we don't know much about, that don't have a lot of history for us to pull from. Is that inviting some kind of speculative bubble like we saw back in the late 90s with all the dot-com stocks? Yeah, you could make that case too. That's why we just watch this and then figure things out on a day-by-day basis. And the mega caps, this is really where the strength has been coming from when we compare it to the equal weight index. Mega cap growth still doing really well, off of the highs here, but in a solid uptrend. And then the robotics and AI ETF looking pretty good above the rainbow, but still underperforming when we compare it to the tech sector. And as I've been saying, later on in the video, I show another AI specific ETF that's doing a lot better than this one is. And then the semis to tech, this we like this going up. That's pretty positive when the semis are outperforming the tech sector. Now, tech sector, that's the biggest growth area, and we want that to go up. But when the semis are doing even better, that's even more positive for the market. And this is still looking pretty solid here. Small caps continue to underperform the S&P. That's no surprise there. And then we have the small cap to S&P ratio in red, and then blue, that's the S&P 500. You can see how the small caps just continue to underperform. Small caps are also really underperforming the tech sector, what we've been seeing for quite some time. The Dow Jones Composite Average, which is the Dow, the transports and utilities, still looking pretty solid there. And then low volatility ETF. These are more defensive stocks, just kind of humming along, seeing a little bit of weakness here, but it's still pretty much chopping sideways. Where we get some insight is when we look at a ratio between the low volatility ETF and the S&P. And this ratio, for the most part, is continuing to go down, and that's positive for the market. Then we look at all the stocks in the world, but we take out US stocks. This is doing quite well, just coming off of recent all-time highs. Then we put US stocks back into the mix and not performing quite as well. 2025 for US stocks, they've done great, but they haven't really been outperforming the rest of the stocks in the world, according to this chart. Growth stocks are still outperforming bonds, government bonds, even though bonds have had a fairly good year. And then energy is still underperforming the tech sector. That ratio continues to go down. The tech sector is outperforming the 10-year yield. And then the 10-year yield is underperforming the tech sector. All right. And then discretionary, we like this. We like when this is seeing a little bit more strength here. Now we look at some other ratios and we're not quite as confident about things. But this one, discretionary to staples, is looking pretty solid currently. And staples are underperforming discretionary. Staples are more defensive, discretionary is usually more offensive. And then gold pulling back here because gold has been coming down. The S&P has been going up. So we've been seeing this ratio coming down a bit. And a similar story here with gold coming back down recently, and the dollar's been holding up fairly well. And so we're seeing this ratio coming back down after it was it was skyrocketing up. Then we look at the advanced decline line studies. We're below the moving average here with the NYSE common stock. That's a little bit more negative. We're right on the moving average with the S&P. We're below the moving average with the mid caps and small caps. So that's where we're seeing a little bit of weakness shorter term coming in. And a lot of that started to really build when Chair Powell made his comments on Wednesday. And we were going up here with the Dow actually outperforming the transports, although it pulled back. The transports had a pretty good day on Friday, where the Dow didn't do all that great. And here are other transports, but they've really gone nowhere. We just kind of come back up into the range that we've been in lately. But overall, they're really not trending. And the transports are still underperforming the S&P 500 on a ratio. And then here, we're just coming off of recent all-time highs with the Dow. Transport's going sideways. Now, the utilities were strong, but they really started to pull back here. A lot of the strength in the Dow Jones Composite is really coming from the Dow right now. And then instead of using traditional Dow theory, we look at the S&P instead of the Dow, just coming off of all-time highs here. Instead of using the transports, we look at the NASDAQ, just coming off of recent all-time highs here. And then switching it around even a little bit more, we look at the equal weight S&P, not coming off of a high all that soon here. This has been underperforming. It's been the really big stocks that have been driving the S&P. And then we have been doing better here with the equal weight version of the QQQs. That's the NASDAQ 100, just coming off of recent all-time highs. We got pretty close here with the equal weight version, but you can see there's not a lot of conviction in this move when you look at the equal weight version compared to the S&P weighted version. And then we look at the transports, not really, they're pretty much neutral now with the correlation between the S&P and the transports. The FANG index just coming off of recent all-time highs, and these are the really big stocks. Then on broad market measure, the Wilshire 5000, recent all-time highs here, recent all-time highs with the total US stock ETF. The NYSE composite still holding up above its 50-day moving average. All stocks, US and international stocks, coming down a little bit here, but still looking pretty solid in the bigger picture. ARC is still in an uptrend. And high leverage loans, this is another barometer of the economy. It's holding up above its 50-day moving average. Emerging markets looking pretty solid here. They're seeing more conviction in this chart. And Bitcoin just kind of hanging out around its 200-day moving average, getting really choppy lately. Micro caps still looking pretty solid here. These are the really small stocks. And then the Japanese Nikkei index just setting all-time highs there. And the semiconductors here, just coming off of recent all-time highs with the SMH semiconductor ETF. This is that same ETF showing how we're well above the rainbow. This is the other ETF, the AI and tech ETF, recent all-time highs here. And then we look at the S&P and home builders and we look at the correlation, pretty strong correlation between the two. We look for divergences and we're not seeing that right now. And we're trying to turn up here with Chinese stocks. They have been in a downtrend. They're trying to recover at least some kind of an uptrend. We're starting to turn up with emerging markets. We're going up with Europe. Japan's pretty much flat, even though the Nikkei is setting all-time highs. And we're trying to turn up and look more positive with the S&P. This is the KST oscillator, which is quite long term, so it can lag sometimes. And then a monthly chart here of stocks to world stocks and we're well above this moving average. Longer term, we're still looking pretty solid. The percentage price oscillator is continuing to go up. And now that we've completed the month, this chart is finished and now it'll start drawing November. And then we look at the price of the 10-year still coming down a little bit here because we were seeing interest rates really starting to go back up after they got below 4%. And that's a little bit of a concern. We're keeping an eye on that. And the total bond ETF, though, coming back down a little bit above its 50-day moving average. This chart just shows on the daily side how bonds are underperforming stocks. And on a monthly basis, stocks are outperforming bonds. And the Pring World Bond Index, not really showing a lot of conviction lately over the last couple of years, but we are still in an uptrend in the recent past. And then high yield bonds, which are junk bonds, looking pretty solid there, just coming off of recent highs. And investment grade bonds, more conservative bonds, they seeing a little bit of weakness here, coming back down to its 50-day moving average and still has a ways to go to get back to its previous all-time high. And the Dow Jones corporate bonds, still looking pretty solid, but showing some recent weakness here. And then the stock to bond correlation just coming out of the neutral camp right now. We've been seeing a shift over the last couple of trading sessions, going back to Wednesday when the Fed made their announcement. They were tending to go in the same basic direction. Now they're having a slight tendency to go in opposite directions. And then riskier bonds to more conservative bonds just kind of humming along sideways right now, not showing an awful lot of conviction there. This just shows you the 10-year yield, how we've been establishing a higher range. And junk bonds coming off of recent all-time highs. And then we look at junk bonds to government bonds, more conservative. Actually seeing junk bonds starting to underperform just a little bit. We're dropping below the 200-day moving average. We're still in an uptrend, but if this doesn't recover pretty quickly, we're actually going to see a death cross here with this ratio. And then how, for the most part, maturities, they've been coming down and then they've been starting to go back up lately, which is really strange. The Fed comes in and everyone thinks they're going to cut rates. And so the 10-year yield's been going down. The Fed comes in, cuts rates, and then the 10-year yield starts going back up. Figure that one out. All right. And then looking at world, this is a weekly chart here, just showing here. We've been keeping an eye on the 10-year yield in Japan, but it doesn't seem to be causing any concern right now, especially for the Japanese stock market. And then the volatility of stocks, that's the VIX. And then on top are the volatility of bonds, that's the MOVE index. And we look at, there's a pretty strong correlation between the volatility of the two. This isn't price. This is measuring the correlation of volatility. And the S&P 500 to 1 to 3 year bonds, you're going to see a lot of the same things here. A little bit of a pullback, but still above the rainbow. This also shows how bonds continue to underperform stocks. S&P 1500 to short-term bonds pulling back a little bit, but still above the rainbow. Same thing we're seeing with the broad market to 3 to 7 year bonds. And I show all these charts and you're seeing the same thing, but we're looking at different things. And so this is just confirming what we're seeing instead of just relying on one or two charts to give us the whole picture. We look at everything we can. This is the tech sector showing how it's outperforming 3 to 7 year bonds, how the S&P 500 is outperforming the 10-year yield. And then long-term chart here of the long-term bond, a monthly chart, starting to come a little bit above the moving average here. That could actually end up being more positive if the price of the long bond is actually going up. And then we look at a ratio between the long-term bond and the CRB index starting to go up here, seeing where the long-term bond is improving in performance after it's been basing now for the last couple of years. Then the different sectors, seeing some real recent weakness here with the materials falling underneath their 200-day moving average, but it's still in an uptrend with the sector by itself, but really underperforming when we compare it to the S&P. Communication, this is a really big growth area, seeing some weakness here underneath its 50-day moving average, even though the longer term uptrend is still intact. And seeing some weakness too in performance when we compare it to the S&P. We would like this to really outperform, but it's not. It's actually underperforming right now, but the uptrend is still going on for right now. And then energy just hanging out around its 50-day moving average. It comes down, hangs out around its 200-day moving average, bounces up to its 50-day moving average. It is in an uptrend, but when we compare it to the S&P, still continuing to underperform. Financials, this is I've been watching this since last spring, looking okay when you look at the financials by themselves. They are under their 50-day moving average. This is what's a concern. If you go back to about the beginning of May, we saw the financials start to really underperform the S&P, and they're still doing that. And it's like, okay, what's the market seeing that the news is not telling us? They're picking up something. There's a reason why the financials are underperforming. We haven't heard about that yet. We're just seeing this in the charts. And at some point, either this chart will improve and, and pretty much negate the concerns that we're having, or there'll be some kind of news that breaks to justify why this chart has been going down. Industrials still not really showing a lot of conviction, but still in an uptrend above their 50-day moving average, but underperforming recent death cross when compared to the S&P. Tech sector, big growth area here, looking pretty solid by itself. Also looking pretty good when we compare it to the S&P. That's where a lot of the strength has been coming from. The staples, really seeing some weakness here, and that's actually positive for the market. This is toilet paper and toothpaste, so that's more defensive and really underperforming when we compare it to the S&P. Real estate, which they're very interest rate sensitive here, and they didn't like it when they said, because they liked the fact that they were going to cut rates not only in October but in December, and they didn't like it when Powell came out and rained on that parade. And when we compare it to the S&P, really underperforming. Utilities coming off of recent highs here, but still looking pretty solid and actually kind of zipping up here and now really pulling back, even though we're just in a recent death cross here with this ratio. But this has been really choppy. And utility, we want to watch this. A lot of times I show this chart every day in the daily videos, but we've been so choppy with this chart now. When this is going up, that means the S&P is outperforming, and that's more positive, but not showing an awful lot of conviction right now. Healthcare actually generating a recent golden cross with the healthcare sector, but kind of possibly forming a base here. We've seen pockets of where folks are coming in and getting a little bit more favor with healthcare, maybe bargain hunting, maybe more of a defensive play if the economy is going to start to run into some problems, but it hasn't switched the overall trend. Discretionary, Tesla, Amazon are part of this, doing pretty good by itself in an uptrend, but not that great when we compare it to the S&P. Now, when we compare discretionary to staples, yeah, discretionary is doing fine. But when we compare discretionary to the S&P, it's not doing all that great. And then the semiconductors just coming off of recent all-time highs. The semiconductor to Dow ratio is continuing to go up. That's positive. Here's another index, the Dow Jones Semiconductor Index, just coming off of recent all-time highs here. And we still have gold, the best performing asset in 2025. Stocks are in second place. Then the purple line, that's commodities. Blue, that's bonds. And we have oil and the dollar kind of tying down here to see which one can perform the worst. They're both negative. And then different correlations, stocks to oil. Fairly strong correlated relationship right now. So they tend to go in the same direction at the same time. Stocks to the dollar, starting to come down and drop more neutral currently. Stocks to the 10-year yield, a little bit of a tendency to go in the same direction at the same time. Tech sector to the 10-year yield, also a little bit more of a tendency to go in the same direction at the same time. And then stocks to the 2-year yield, more of a tendency to go in the same direction at the same time. And then some long-term charts here. Now, the NYSE composite, this is a monthly chart. You can see we're pretty much in an uptrend here. But the Copic curve, going back to the beginning of 2025, it's actually been going down. Now, I don't put everything in the Copic curve. If you watch other videos that I have, this might be negative, but all the other charts that we look at that measure the same kind of thing as the Copic curve, they might all be positive. That's why I use a lot of different charts. And then looking again, here's the monthly chart of the NYSE and then the NYSE record high percent index. Seeing a little bit of weakness here after it had been really coming back up. And then the S&P looking pretty good from a long-term trend perspective and also going up with the percentage price oscillator. And then the S&P on top again, and then stocks to commodities longer term. We're starting to see this turn back up, where stocks are starting to outperform commodities. We'll see if that can continue longer term. And then another US to world measurement here, a long-term monthly chart still holding up fairly well here, but the KST, another long-term momentum oscillator, that's continuing to go down. So, and then here are all the positive things. And if you watch these on a regular basis, you can just pause this and look at what I have listed here. It's not everything that I went through in the video, but these are the main areas of the market that I tend to follow, and they haven't changed. And so you can just pause this if that interests you. And the list on the negative side is pretty short. We just have the dollar by itself, it's in a downtrend, and then the Japanese yen, which is in a downtrend compared to the US dollar. Thank you. I hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.